Hi everyone, welcome to my YouTube channel. My name is Tabitha. If you're new to this channel, welcome and please subscribe for more videos. Today we are going to talk about how, not how, let's start again. Hire more videos. Today we are going to talk about investment account in Canada. So if you want to invest or you want to start your investment journey, so what are some of the accounts that you use when you want to invest? And what are some advantages, disadvantages, features that you need to know before you select individual accounts? So I have put together slides and then I will explain one by one and why do you want to use this account and why should you not use that account. So we will start the video. So we are going to look at the investment account in Canada, like I've said before in the introduction. So what are this investment account that you need to put your money in if you are ready to invest or plan for? So there are different categories of investment account in Canada. So we have these two categories. One is non-registered account and the second one is registered accounts. So what makes the difference? Yeah. So the non-registered account are not registered with the government, but they also know like what is going on in your non-registered account. So the income that you earn from there has to be added to your regular income that you earn from your job. If you are making money in your non-registered account, so you have to comply with the rules and report that money with your regular income. The non-registered account are the registered accounts are also under the government too. So it depends on which one you choose when it comes to tax implication, right? So now let's look one by one, like which one is which and what are the example. So for example, we have the non-registered account. They have two common ones. So one is the cash account and the other one is marginal account. So cash accounts are like example, like those of checking account that you have with your banks and some of the cash account that you can have with your investment companies or brokers. So those cash account, any activities that goes on there, the interest that you earn from that cash account, the dividend you earn there, anything that you earn on top of that, they are taxable because they're not registered, they're in non-registered account. So they are taxable. So these are basic, it's a basic account and it's taxable. Anything that you earn from there is taxable. It's not tax shelters. There is no tax shelters benefit that come with this account. So like, for example, if you have a cash account with Questrade, so, and you do your day trade there, swing trading investment in that account, any dividend that you had from there, any interest, anything that you had from there has to be added to your regular account. So you can report to the government that I was making money on the side with cash account, and this is the amount of money that I had. So that amount, let's say you make 10,000 from your cash account with Questrade, that 10,000 has to add to your regular employment income. So if your employment income was like 30,000, so now your total employment income would be 40,000 plus you take the 10,000 plus the 30,000 that you make. So at the end of the day, you will be paying more taxes on this account, right? So you will have your income will go up and you will fall on high taxable bracket, right? So this one is going to like, it's not, they have no tax benefit. Cash account have no tax benefit. You only need to use it for trading, or maybe if you're doing swing trade, something that if you're handing more money, that's the only time that is advisable for you to invest in this account, because you will be paying more taxes than you anticipated. So only use it when you do day trading and you're making more money every time. Because if you're not doing, if you will do that activities in the other registered account, you will be stealing money from the government because you're not paying taxes as required. So the cash account, only use it when you're doing day trading and you know you're making more money than usual, okay? So another form of non-registered account is marginal account. So marginal account, what they are both similar with cash account, right? They have similar features with cash account. The only difference with the marginal account is that it's like for people who are doing business, people who want to use other people's money to make themselves money. It's mostly for leverage kind of activities. So they are as same as cash account. They are also taxable. So whatever you earn from that account, marginal account, you have to report it. So you add that amount of money to your regular income so you can pay taxes to the government. So another features of marginal account is that one of borrowing, right? So if you have like 1,000 and you want to invest, right? Or maybe you want to trade and you know like having 2,000 will be better. And then this account will give you that extra 1,000 you want to borrow. So you can do your trading account. You can do your trading activities and make more money using other people's money. But you have to be like very well experienced to use this account because it's dangerous. Because you can borrow that money, 1,000 extra 1,000, you invest it in some other stocks, and then later on you lose your stock. What happened is like you will pay back the 1,000 that you borrowed, and also you have to pay interest on that account. So this is like how people will end up screwing themselves up because they want to make money quick. So they go open marginal account and then they borrow money from the broker. And then at the end of the day, because they had no experience in trading or investing, they lose their money. And then now the broker or the bank is owed. They have to pay back the money to that company and plus interest. So if you want to use this account, you have to learn how it works and also do like some of financial literacy on how it works, right? So you don't go and screw yourself up and then you're here in debt instead of making money, right? So borrow money, invest them, but do it in a from a very educated experience. Use it so I don't screw myself up. Okay. So the next category is registered account. So this come into form TFSA and RRSP. So the TFSA is this registered account that help you to grow your investment tax-free. So the amount of money you contribute to TFSA is considered already taxed before, right? Because it's like if you earn your income, let's say you make 3,000 a month and you pay your expenses, and then because you are like frugal kind of person, you have cash left after you pay your expenses, right? So let's say 500 every month is left when you pay your expenses. So if you take that 500 and you put it in your TFSA to invest, or trade. So this money can grow tax-free. The interest you earn on this money, the dividend you get on this money, the capital gain you get on this money will be tax-free. Let's say you contribute 500 and then later on it grows to 1,000, and then at the end of the month you want to withdraw that 1,000. So the whole 1,000 is not going to be taxed because it is tax-free. The 500 that you put in before was already taxed, and then the money that grow on that 500 is growing tax-free. So that is the advantage of TFSA over cash account or marginal account, because it doesn't matter whether you put that money in cash account and it was already taxed. Yeah, since it's already not in the registered account, it's not considered already taxed. But the TFSA, it gives you that tax advantage that whatever you grow on your income that you contribute into it is tax-free. You will withdraw that 1,000 and you don't have to pay tax. So TFSA, and everyone has a room in Canada that you should contribute to. Like my room at this moment is about 70,000, right? That's the room. So if I had money, I'm making more money from here and there, right? And then I can contribute to that room, max it out to 70,000, right? And then if that money grows to 100,000, I can withdraw that 100,000 without paying tax. The extra 30,000 is just the benefit of growing your money on in TFSA. It will not add onto your regular income and be taxed. It's already considered free tax account. So if you grow that money there, so use your TFSA room. If you have, don't just let it sit there, because if you invest with TFSA, you can take that growing your investment without being taxed, right? The money you had from there is not taxable. There's a year like in 2020 where I used my TFSA, like the 10,000 on that year that I had from TFSA was tax-free because I grew it in the TFSA and it's legal. So I didn't have to pay tax on that 10,000. Instead, I only pay tax on the regular incomes that I made. Continuing with the TFSA features. So this one is like you can withdraw, like I said before, you can withdraw anytime, and whatever you grew in that account is considered not taxable. So you put your 500 in, you bring it out as 1,000, no one will bother you taxing that extra 500 that you grew inside TFSA. You can contribute to up to annual contribution. Everyone has their room. So maybe next time I can make a video how to know how much room you have accumulated over the years that you have been a Canadian citizen, or since the time that you turn 18, because everyone has that room. So if you contribute that to your TFSA, you will max out that TFSA room and you have the opportunity to invest your money and grow your money in a tax-free account like TFSA. So going to the next example of the registered account is RRSP. So RRSP is registered account, and mostly it's very good for people who are making more money every year, because this is how they can get back their taxes from the government, right? And if they wish to pay less tax, right? Yes, so it's used for tax deductible on your tax return. So if you're making 70,000 this year, right? And you contribute, let's say your room for this year is only giving you 6,000, right? So if you contribute 6,000 to your RSP, you will be taxed on only 64,000. So if 64,000, the amount of tax that you will pay will depend on the tax bracket your new income after you contribute to RSP falls. So if it falls lower than your normal tax bracket, and then you pay less tax that year. So on your tax return, you will get more money back from the government. When it comes to RSP too, withdrawing depends. So if you just withdraw, if you withdraw from your RSP without any other registered program, and then you have to pay taxes that year that you withdraw from your RSP. Okay, so let's say you take 20,000 out, and this year you are making 70,000. So that 20,000 will add on to your 70,000, and you will be taxed on 90,000. But if you withdraw it using the other registered program, and then you won't have to pay taxes. The other registered programs are different, right? So things like retirement, if you want to keep it until your retirement, right? And then the other one is like school. If you want to go to school and you're not working, you can withdraw from your RRSP. So it means you will pay less taxes or even no taxes, depend. If you want to buy a house for the first time, and then you qualify for that incentive of withdrawing from your RSP up to 35,000 without paying taxes. So it depends on how you use it, okay? So this account is registered, and that's how it operates. If you want to use it, then you can check one of my videos that I've made about RSP, and you will learn more about RSP and then how you can use it without hurting your finances. Okay, so this one we can this is the end of the video. If you like this video, like it, comment, and subscribe for more videos, and I will see you next time. No.